What's up, guys? Welcome back to another YouTube video. On this one, I'm going to be talking about how I use the volume indicator as a confluence in my day trading strategy for NQ. And like with anything else that I talk about on my channel, this is just my opinion based off of my own personal experiences. I've exclusively traded NASDAQ futures for several years now, so this concept has not been tested on any other asset. I believe that this methodology should work on any tradable asset, but again, that's just my opinion, and it's not me stating that as a fact. Especially with this indicator specifically, there's a lot of nuance, and discretion is a massive part of how to utilize this properly, so please keep that in mind. With that out of the way, let's get started. A lot of people are familiar with these volume bars, but like with anything else in the trading space, there's quite a bit of confusion on how to actually use this. I had a hard time personally finding a simple and practical video to explain this when I first started out, so hopefully this helps somebody out. So I'll be going over the basics as well as a few scenarios where I use volume as a key confluence before I take a trade. So first up, what does the volume indicator even mean? These bars basically show you the total number of orders that have been executed within each candle. These are orders that actually got filled, and these bars do not represent how many orders were placed and then did not get filled. So that's a common misconception, but long story short, these bars show you how many orders were executed within that time frame. In regards to the New York Stock Exchange and futures market, the volume will always be highest during the first hour and a half of New York session compared to Asia or London session. And this is why the moves during the New York AM session are much faster and more volatile than any other time of the day. Also, a good rule of thumb that everyone can apply going forward in their own trading is that if you see volume decrease significantly and sustain at that new lower level, odds are that price is just going to be chopping around in a range, and it's best not to take a trade unless there's either a break above or below that range along with an increase in volume. So this is a pretty good example of what I'm talking about here. So you can see from about 10:15 to 11:15 a.m. this morning, we're just kind of chopping around in this range, and you can see that volume was declining during this time. So the price action is looking like this. I will always look for a break above or a break below that consolidation range before I take any trades, and I don't want to take any unnecessary risks by trying to trade inside this chop. And especially if you are newer, I would suggest you do the same. Just like anything else in the financial markets, volume does not have to have a clear reason for why it started spiking or declining out of nowhere, but generally it lines up with things like news or the time of day. If it's news related, usually volume will die out shortly before a big event like CPI or FOMC, and then violently spike once the news comes out. And generally, again, it will break out of that low volume consolidation zone that it was in previously. Also, usually volume will be lower from roughly noon to 2:30 p.m. Eastern from Monday through Friday during the New York sessions. Whether you think this is because the traders at the quant firms or institutions are getting lunch or whatever other reason, it doesn't matter. This is just an objective observation on how volume generally acts throughout the days. So again, especially if you're newer, I would suggest you stay away from taking a trade when there's low volume and prices consolidating, as well as shortly before news. I personally will never take a trade if we're within 10-15 minutes of a big news event. I'll just let price kind of settle out and wait for that newsprint to come out, and then I will look for a position after. Next up are the two main setups that I like to take while using volume as a confluence. First is this. So say we have a break above a key level. Almost always the volume candle on the breakout candle will be higher in relation to the rest of the candles. If you cannot tell, this is my illustration on the volume candle on this initial breakout. So if you think about it, this would make sense because obviously you need more buying pressure than normal to push through the sell orders that were set at that level. So we have this breakout with high volume, and usually there's a pullback to retest that same level right here. This is the pullback in my illustration, as you can see. So I take all my entries on the 1 minute chart. So I watch this chart very closely to see how price reacts when we get that pullback. If we get an aggressive and high volume push to the upside through that level, but then immediately get a high volume rejection and come back into that same level, I'll be more cautious than usual, because that means that there are still enough sellers betting that price will head lower and start to reverse through that level. However, if we get a pullback in the 1 minute chart and the volume candles are notably lower, this is where I get interested for a long entry. So the lower volume pullback tells you that there isn't a whole lot of selling pressure here, and it generally will set up so that new buyers can step in off of the retest of this key level and continue the breakout to the upside. All right. So like I say for every strategy video or to the people in my live trading streams, nobody can predict with 100% accuracy in which way price will move. But as traders, we are in the business of taking an educated guess based off of the confluences that we use, right? Like if I could consistently predict price 100% of the time, I would not be making this video and you would not be watching it right now. I'd probably be off on a 100-acre ranch in Montana or something, but obviously that is not reality. And I don't think there's anybody out there that can do that on a consistent long-term basis. So we have to use the hints that the market gives us and take a trade based off of the highest probability outcome. So even if we get this low volume pullback here, that does not mean that a long here would work every single time, right? It could absolutely continue to sell back through that key level and then continue to reverse. But statistically, the odds are more likely for a bounce in this case. So in the long run, you should make money as long as you're disciplined with your entries and manage your risk properly if you take longs off of a low volume pullback like this off of a key level. The reverse of this is also a nice setup that I like to take. So if we get a breakdown below a key level and get a pullback into that level off of low volume, I'd be looking to go short off that retest of this level right here. Same exact concept as the first scenario, just flip the chart and you got your setup right there. So the second setup is a reversal. So say that price moves down into a key level, wicks down, and then immediately gets bought back up. In this case, you will end up with a candlestick that looks something like this, right? So you have a long wick down, and then the actual candle body closes above that key level. This candle would print right here. Okay. Currently, I don't have the artistic talent to draw a bunch of these candles, but you get the point. The main thing is that this candle will show up right here, right where price wicks down and then closes back above that spot. And at the same time that this candle prints, the odds that the volume spiked right at that same spot are pretty good as well. This would show that buyers are stepping in to protect that level and there's not enough selling pressure to get price lower and to close below this level. Right, so if we get a candle close as well as a volume candle to print like this, I'd be waiting for a retest back down toward that same spot and enter long off the retest. What I mean by that is say we get that hammer candle to print right here, and then price cannot close below that level. I would be looking for a decent little pop above and then a retest once again off of low volume. This is a lower volume retest right there. And then I'll be looking to take this long off of that retest right there. Statistically, I like my odds very much with this exact reversal setup. So initially you get that push down below the level, but then the candle closes above, pops back above, and then retest that same level once again off a lower volume. Then I would enter long right here. Again, the same goes for the reverse of this. So just flip the chart upside down. Say you get a push up into a previous resistance, get a nice wick up, but candle closes well below that level along with volume spiking. I'd be looking to go short on the next retest of that level with lower volume. For my personal system at the moment, I'm the most comfortable when I enter on the retest of a key level or confluence. I will rarely try to enter on the first touch of any level, no matter how big of a support or resistance this is. This is only because of my personal risk tolerance, and in my opinion, I don't think that trying to time the top or bottom will be a profitable strategy in the long run. Even if your idea was correct, price can always wick above or below 30 to 40 points before reversing or moving back in that direction you wanted. So for that reason, I will always wait for the retest before entering any positions. But that pretty much wraps up this overview of how I personally use the volume indicator within my strategy. Hopefully you found this useful. Also, all of my links as well as my Discord in the description below. I'm live trading every single day in there, so check that out if you're interested. There's also a free side of the Discord that contains a ton of educational content that I wish I had found much sooner in my personal journey. So again, feel free to check that out as well as the other videos on my channel. Thank you again for watching and take care.